Imagine a man who believed he was stronger than the tide. In the spring of 1929, the American economy began to shudder. A hairline fracture appeared in the foundation of Wall Street. The Federal Reserve panicked, tried to tighten the reins, but one man, the chairman of National City Bank, stepped to the podium and defied the gods of finance.
"We feel," Charles Mitchell declared, "an obligation which is paramount to any Federal Reserve warning." He pumped $25 million of his bank's money back into the market, single-handedly restarts the heart of a dying bull. He was hailed as the savior of capitalism. But by October, that same man would be watched by a nation as he presided over its total ruin. How did the banker's banker become the most hated man in America? And was he a visionary who flew too high? Or a salesman who sold a lie he actually believed?
To understand the fall, you have to understand the height. The 1920s weren't just a decade, they were a fever. After the carnage of World War I, America was the world's factory, its creditor, and its undisputed king. Before this era, the stock market was a private club for the elite. If you were a plumber in Ohio or a teacher in Maine, Wall Street was as distant as the moon. Enter Charles "Sunshine" Charlie Mitchell.
Mitchell didn't just want to manage money. He wanted to democratize greed. He transformed National City Bank, now Citibank, from a conservative vault into a high-pressure sales machine. He hired 350 salesmen. He opened retail offices in 50 cities.
He treated stocks like vacuum cleaners or Ford Model Ts. He told the average American that it wasn't just their right to be rich, it was their duty.
By 1929, nearly 4 million Americans were in the market. Most of them were there because Charlie Mitchell had invited them in.
How did Mitchell build this engine of prosperity? He used 3 primary levers: the sales force, the fuel. Mitchell's investment houses were the first of their kind. His salesmen were trained to push securities with the fervor of evangelists. They weren't selling value, they were selling the future.
2. The affiliate, the loophole. At the time, commercial banks weren't legally allowed to gamble on stocks, so Mitchell created the National City Company. It was a separate entity that lived in the shadows of the bank. This allowed him to use the bank's prestige to sell incredibly risky, often worthless, bonds and stocks to unsuspecting depositors. 3. The margin, the trap. This was the relatable analogy. Imagine buying a $1,000 house, but you only put down $100. The bank lends you the other $900. If the house value goes up to $1,100, you've doubled your money. But if it drops to $900, you've lost everything. And you still owe the bank.
Mitchell encouraged buying on margin. It was a system built on the assumption that the sun would never set. Between 1927 and 1929, the amount of money lent to investors to buy stocks tripled. It was a mountain of debt disguised as a mountain of gold.
Mitchell wasn't just the mechanic, he was the cheerleader. He used his own bank's funds to support stock prices whenever they dipped, creating a false floor. He made the market look invincible, while the weight it carried grew heavier by the hour.
September 1929. The air turned cold. The Babson break sent a shiver through the exchange, but Mitchell remained defiant. He dismissed the dip as a healthy correction. Then came Black Thursday, October 24th.
The market opened like a trapdoor.
At noon, the great men of Wall Street met at 23 Wall Street, the offices of J.P. Morgan. Mitchell was there. They pooled their resources to buy stocks and restore confidence. For a few days, it seemed to work. But the panic was a contagion no bank could cure. Black Tuesday, October 29th. The floor fell out. 16 million shares were traded. The ticker tape ran hours behind. Investors who had bought on margin were wiped out in minutes.
Mitchell's own fortune, estimated at $20 million, vaporized. But it wasn't just his money. It was the money of the widows and retirees he had persuaded to buy National City stock. That stock, which peaked at $585, would eventually crash to $4.
The sunshine had gone out. The Great Depression had begun.
The aftermath was a reckoning. In 1932, the Senate established the Pecora Commission to investigate the cause of the crash.
Charles Mitchell was the star witness, but he wasn't a hero anymore. Under the relentless questioning of Ferdinand Pecora, the ugly truth emerged. It was revealed that while Mitchell was urging the public to buy National City stock, he was secretly selling his own shares to avoid taxes. He had used bank funds to provide interest-free loans to his executives so they could cover their own losses, while his customers were left to starve.
The public was incandescent with rage. Mitchell became the face of bankster greed. He was arrested for tax evasion and sued for millions. But the ripple effects went beyond one man. Mitchell's actions led directly to the Glass-Steagall Act of 1933. This law forced the separation of boring commercial banking and risky investment banking. For 60 years, it kept the system stable. It was a direct response to the Mitchell way of doing business.
However, history is a circle. In 1999, under intense lobbying, the core of Glass-Steagall was repealed. The man leading that charge? Sandy Weill, the CEO of Citigroup, the successor to Mitchell's National City Bank.
Within a decade, the 2008 financial crisis would mirror the 1929 crash with haunting accuracy. The same affiliates, the same hidden debt, and the same belief that the sun would never set.
Charles Mitchell eventually paid back his debts. He died in 1955, a wealthy man once more. Though his reputation never fully recovered, he wasn't a cartoon villain. He was a man who believed his own sales pitch. He thought he could engineer a world where no one ever lost money.
But in finance, as in physics, every action has an equal and opposite reaction.
When we democratize the potential for massive gain, we also democratize the potential for total ruin. Mitchell's ghost still haunts every can't-lose investment and every new era of prosperity.
The unsettling truth is this: we don't hate the Charles Mitchells of the world because they were wrong. We hate them because for a while, we really wanted them to be right.
Today, we have apps that make trading as easy as playing a video game. Are we living in a new sunshine era, or are we just waiting for the next October?
If you had $1,000 today, would you trust the market or the mattress? Let me know in the comments.